Today we're going to talk about how money works and what it means for the global economy. You've heard a lot about the US-China trade war and everything that's going on from a global perspective, but it's important for us to understand where and how this all started. So today, we're going to do just that. Despite all of the global uncertainty, the stock market continues to rise, hitting yet another all-time high. If you moved your money to the sidelines, you would have missed out on a cool and easy 20% gain simply by investing in the S&P 500 this year. And despite what the bears and analysts tell you, I've repeatedly shown you how to gauge the market by following one of the most accurate market indicators. If you don't know what that is, you can go back to a previous letter called The Most Accurate Market Indicator. But today, I want to revisit a letter I wrote back in 2016. Why? Because not only does it provide many of the answers as to why the stock market is moving higher, but it also helps us gauge and understand what's really happening with the trade war between the US and China. And with gold once again surpassing $1,400 an ounce, something we haven't seen in nearly 6 years, it may also help you understand why gold is rising and where it may go next. Here we go. A mass exodus of wealth is coming. It'll be a cataclysmic event unlike anything our world has ever seen. It'll be so powerful that it'll make all previous financial disasters look like a bed of flowers. Yet, contrary to what you might be thinking, I'm more heavily invested in the market than I have been in a very, very long time. But why? Wouldn't that be in direct contradiction to what I just said? Shouldn't we exit the market if such a financial disaster was coming? In order to answer this, it's best I explain things from a macro perspective. Every economic boom over the last few centuries was created as a result of credit expansion. Every economic bust was also created as a result of credit expansion. So let's go back in time to understand why. Not long ago, trade between countries were conducted by exchanging goods and services. For the simplicity of this story, we'll use gold as a currency of exchange, since every nation viewed gold as money back then. A few hundred years ago, trade between the English and the Dutch were strong. When the English traded with the Dutch and imported more than it exported, the English would have a trade deficit. To take care of this trade deficit, England would send gold to the Dutch Republic as payment. Since gold was the only real form of money, England's money supply would contract. This contraction meant English banks would then have less money to lend out, which meant interest rates would rise because the cost of borrowing would go up, which meant less money was available for economic growth. If this continued, it would eventually lead to an English recession and inflation would take place. But the opposite would happen to the Dutch. The trade surplus meant the Dutch had more gold, and since gold was the only real form of acceptable currency, this meant its money supply grew. The increased money supply meant the Dutch had more money to lend out, making borrowing cheaper and thus expanding credit, which led to an economic boom that eventually caused inflation. With more money, the Dutch purchased more English goods, which were cheaper as a result of England's deflation. The English, on the other hand, had less money and couldn't buy as many Dutch goods because Dutch goods cost more as a result of inflation. Eventually, England's trade deficit with the Dutch Republic would come back into balance. This would go back and forth until that happened. But in other words, the international balance of trade was maintained by using gold as money. But this balance only lasted as long as money was not manipulated. Prior to World War I, the world operated on a gold standard, where gold was the only form of acceptable money globally. But then, when World War I started, none of the countries had enough gold to finance the war. So what did they do? They printed money to fund all of the government bonds and deficit spending required to fund the war. When the war was over, there was so much money created from printed debt that it fueled a global economic boom led by Western nations. We know this boom as the Roaring Twenties. American companies had record production figures, increasing sales, and millions of dollars in profits. These profits led to high dividends and even higher share prices. So thousands of investors flocked to the stock market, and many leveraged themselves and borrowed money to buy even more stock. No one ever thought this boom would end, but American companies began to produce so much that it was making more goods than consumers were able to buy. This, in turn, led to declining sales, prices, and profits. And with all of the debt that was accumulated during the war and the boom thereafter, much of it couldn't be repaid. This led to the Panic of 1930. In 1930, when much of the debt couldn't be repaid, the US stock market collapsed, the money supply collapsed, the banking system collapsed. This led to the international monetary system collapse, which led to the collapse of world trade. Over the next decade, the entire world was stuck in a rut, and this became known as the Great Depression. The Great Depression had profound effects on American society and the world. Millions of people lost their jobs and their homes, thousands starved to death, and suicide skyrocketed. With the Depression raging on, World War II started. Again, in order to fund the war, the US government increased spending by a whopping 900%, with defense spending climbing to an incredible 41% of GDP. That's 41% of all the goods and services the country produced. The world needed a new financial system, one that global trading partners could trust, and one that could prevent currency manipulation with strict financial controls. In other words, the world wanted a system where governments couldn't just manipulate their own currency to impact trade, and one where there wouldn't be an unfair rise and rapid credit expansion. The only way to do that was to create a system backed by something that not only holds its value, but couldn't be as easily manipulated. And that something was gold. But going back to a gold standard meant deflationary concerns would once again rise for many nations. Furthermore, the US had now controlled nearly a third of the world's gold after World War II, and international trade simply couldn't exist in a world where one side had all of the gold. So the Bretton Woods system was created, whereby the US dollar would serve as the international currency, backed by gold at a fixed price of $35 per ounce. Under this system, countries holding US dollars had the right to convert those dollars into gold at the specified price of $35 an ounce. This system worked, but not for long. The US began to overspend during the 1960s to fund the Vietnam War and its many social welfare programs. That meant more and more money had to be printed to fund all of President Johnson's exuberant deficit spending. But the Federal Reserve couldn't just keep printing money. Why? Up until about 1968, each Federal Reserve Bank had been required to hold a gold certificate reserve of not less than 25% against its Federal Reserve note liability. In other words, if the Fed wanted to print $100, it needed at least $25 worth of gold to do it. But the US gold reserve has shrunk so much that the Federal Reserve banks couldn't issue any more dollars because they didn't have enough gold to back it up. So President Johnson got approval from Congress and removed the law that required the Fed to maintain this gold backing. From 1968, there was no longer any backing for gold domestically. Meanwhile, the value of the dollar kept increasing. As a result, US trade deficit continued to climb. The rising value of the dollar made it better to invest the dollars outside of the US, so US banks and corporations began investing even more dollars in foreign nations such as Europe. Of course, this caused more dollars to leave the US, which meant an ever-growing trade deficit. As US government spending continued to rise, along with the uncertainty of government policies, foreign nations holding US dollars began converting their dollars into gold. As a result, the US lost half of its gold reserves in the 1960s. By 1971, there were 4 times the amount of dollars overseas than the US had gold for conversion. So in that same year, President Nixon told the world they would no longer be able to convert their dollars into gold. By 1971, there was no longer any backing for gold internationally. The world was in shock and the global monetary system collapsed. Under the Bretton Woods system, currencies were all pegged at a fixed exchange rate, and trade, for the most part, was in balance. But as soon as Nixon removed gold backing internationally, along with record government spending, the system collapsed. Inflation took over and commodity prices skyrocketed. Oil, for example, went from $3.60 to over $35 in 10 years, climbing nearly 900%. Fixed exchange rates became floating exchange rates, and trade imbalances began to blow up. Most of this deficit was with Japan, and that meant a boatload of dollars went into Japan. All of these dollars going into Japanese banks caused rapid deposit growth. When banks hold deposits, they have to lend it out. Otherwise, they would be forced to pay interest on those deposits. So in order to make money, the banks have to lend those deposits out. Otherwise, they would lose money. All of the dollars entering Japan caused a massive credit boom, which fueled the Japanese stock market and had stocks there trading at 100 times plus PE multiples. It also sent property prices skyrocketing. But the surplus kept getting bigger and bigger because the US didn't deflate because it didn't run out of money. The US kept on printing and Japan kept on absorbing all of those printed US dollars. Now here's the kicker. When US dollars enter Japan, the Japanese can't spend it at home because it's not their currency. So they have to convert their dollars to yen by trading dollars for yen. But when that happens, it decreases the money supply of yen. This would force the yen higher and eventually take away the currency benefit of having a cheaper yen, leading to lower exports and a tumbling economy. It didn't take long for central banks around the world to realize that without a gold-backed system, they too could print money and use that money to buy dollars to hold down that exchange rate. Eventually, however, the Japanese economic bubble popped. The bubble was so big that Japan today is still battling deflation and is no bigger today than it was in 1993. Enter the Plaza Accord. Between 1980 and 1985, the dollar had appreciated by about 50% against the Japanese yen, the Deutschmark, French franc, and the British pound, the currencies of the next four biggest economies at the time. In order to fix the massive US trade deficit, these five nations reached an agreement to devalue the dollar. This became known as the Plaza Accord. By 1987, the dollar devalued by as much as 51% against the mark and the yen. By 1991, the devaluation brought the US trade back into balance. Of course, this balance didn't last for very long. Enter China. After the Plaza Accord, trade relations with China and the US coincidentally began to get a lot better. And with a massively devalued dollar, US corporations began looking elsewhere for cheaper labor. This is where China starts coming into the global economy, along with other Asian countries. The cheap workforce in Asia led to an increase in US trade, and so the US trade deficit grew once again. By August 2006, the US trade deficit had grown to a record high of US $762 billion. That's nearly $1.5 million leaving the US every minute. This, of course, was great for the global economy. But as the trade deficit got bigger with China, China's surplus got bigger as well. That meant China now had a ton of money coming into their country. And as we just learned in the case of Japan, when money enters China, it causes rapid deposit growth, leading to rapid credit expansion. It also forces China to print money in order to hold down the exchange rate. That's how China's foreign exchange reserves grew to over $4 trillion, while Japan holds over $1 trillion. That's also why both Japan and China have printed trillions upon trillions of their own currencies. When the US prints money, China and countries all around the world do so as well. That means every dollar the US prints increases the global money supply exponentially. But that's not all. China and Japan can't just leave their foreign reserves sitting in a bank doing nothing, because if they did, it would simply sit there and potentially lose value over time as inflation picks up. So it has to invest it in US dollar denominated assets such as US real estate, US stocks, and of course, US corporate and government bonds, otherwise known as debt. Of course, this pushes the price of everything in the US higher, including stocks and bonds. And when the prices of bonds go up, yields go down, so interest rates go lower and lower. This massive amount of investment back into the US was what helped finance the bonds issued by Fannie Mae and Freddie Mac, who borrowed trillions of dollars, largely financed by these foreign central banks. This, along with low interest rates caused by the bond buying spree, pushed up housing prices and created the housing bubble that burst in 2007. As you can see, all of the money leaving the US goes back into the US, fueling the financial bubble. And the bigger that bubble became, the more money Americans had to buy things from China and Japan, thus fueling the bubble even further. This is the main reason why the price of bonds and stocks in the US are so high and why interest rates are so low right now. It's why real estate prices all over Canada have skyrocketed. It's also why we're in the biggest financial bubble the world has ever seen. Which brings us back to today. Keep in mind that I said this in 2016, yet it still applies today. When the 2008 financial crisis hit, as a result of rapid credit expansion, the world tumbled. Today, we're in an even bigger bubble than we were in 2008 because, as I just explained, all of the dollars printed to fix the 2008 bubble has exponentially grown the global money supply and fueled an even bigger credit expansion worldwide. Asset prices and the global economy are being held up by the rapid expansion of credit and low interest rates around the entire world. If and when interest rates rise, asset prices will crash and the economy will likely sink into a very deep recession. We already saw this happen in 2015 when the Fed raised rates just slightly. The question is, when will the central banks allow interest rates to rise? In most of the world, central banks aren't allowing them to. It is only in the US where the Fed has hinted at raising interest rates, yet failed to do it every time. And even when the Fed does raise interest rates, you can bet that massive stimulus measures would follow. A few weeks ago, again, keep in mind we're talking about 2016, I wrote the letter and asked the question, can the Fed buy stocks? Here's the excerpt. Even more disturbing are the hints Yellen gave suggesting the Fed could break policy and consider some additional tools that have been employed by other central banks. This, of course, includes buying a wider range of assets or raising the inflation target, both of which means the Fed will own more for less. It could also mean that the Fed may buy equities in the future. In other words, raising rates would undoubtedly be a threat to the economy and political stability, unless the Fed were to do something else, something like QE4, for example. And that would mean another massive increase in the global money supply. In fact, precursors to QE4 are already here. In May 2016, I wrote about how America's biggest banks were already being forced to lower their lending standards and thus creating the next housing bubble. Wells Fargo has already started offering a new type of mortgage that requires a tiny down payment and could appeal to customers who might otherwise get loans backed by the Federal Housing Administration. They're not the only ones offering these non-FHA 3% down riskier mortgages. JP Morgan also announced the launch of a similar product. And the Bank of America already announced a similar program back in February of 2016. And it turns out Freddie Mac also wants in on the fun. Here's an excerpt from Realtor Mag, September 2016. In a new pilot program, Freddie Mac and two non-bank lenders are easing income and documentation requirements for mortgage borrower applications. Now get this. In the new pilot program, Freddie Mac says that applicants will be able to use the income of others who live with the borrower who aren't going to be on the mortgage to qualify. But that's not all. Income from second jobs that borrowers have held even for a short period of time can now be factored in. The program will also not require borrowers to come up with bank statements to show how they save for their down payment. End excerpt. We're already seeing 2008 all over again, only on a much bigger scale. Again, keep in mind I wrote that in 2016. And today, in March 2019, the Federal Housing Administration finally told lenders that it would begin flagging more loans as high risk. Here's an excerpt from the Wall Street Journal. The FHA's decision to tighten underwriting standards could mean fewer first-time homebuyers are able to get mortgages. The move is an about-face from a 2016 decision to loosen underwriting standards. At the time, the FHA removed an earlier rule that required manual underwriting for mortgages with a credit scores below 620 and a ratio of debt to income above 43%. Since that happened, we have observed a steady increase in the endorsement of higher risk loan, Mr. Becker said. And he said it with good reason. If you take a look, since 2012, the credit scores of FHA borrowers have been declining dramatically. And shares of FHA borrowers whose debt payments are more than half of their incomes have risen to a high in 2018 of nearly 25%. Now let's go back to my letter from 2016. China, now considered a global economic leader, has been producing an excessive amount of goods and has a ton of additional industrial capacity. In fact, in just 3 years from 2011 to 2013, China produced more cement than the US did in the entire 20th century combined. And it hasn't slowed down. This is eerily reminiscent of what led the US to the Great Depression. I expect that while the US dollar has been strong in anticipation of the Fed hike, the US dollar will likely fall against the yen, the euro, the Canadian dollar, and the Aussie dollar going into the new year and maybe even before. So don't be surprised to see gold climb higher as the US dollar drops in value. I believe the only way to protect and prepare ourselves for this rapid credit expansion is to build as much wealth as possible and transfer it to the things that matter most, like your home, for example. Over the years, and including some of my most recent letters, I've told readers to take advantage of this massive financial boom. Here's an excerpt from my 2016 letter, Can the Fed Buy Stocks? Our job is to protect our wealth based on central bank policies. This includes everything from investing in and exiting the right areas at the right time. Yes, gold is just one of the viable long-term options in this regard. We're in an era of cheap money, and there is a lot of it, but only if we put it to work. Holding cash means you're likely losing wealth over time. If you want to protect your wealth, you have to put it to work. That is the position the central banks have put us in. If we sit here and do nothing, and risk nothing, we'll see the value of our money depreciate very rapidly in this world of expanding money supply and credit. We have been very lucky over the past years and have had some incredibly big winners in our stock ideas. We field a lot of these profits into new and more investment opportunities and will continue to do so until we see stronger signs that the economic reset button is about to be pushed. I wrote most of this letter back in September 2016, but I'm sharing it with you today because I think it's imperative that you understand what's going on in the world. Despite all of the uncertainty that has shrouded our global economy, stocks have moved higher, as I just explained they would. Furthermore, this letter also gives us strong insight into what is happening now with the US-China trade war and how it all started to begin with. So despite all of President Trump's attempts to balance the trade deficit with China, he's going to fail. Tariffs won't be enough, nor will some sort of currency agreement like the old Plaza Accord, where China agrees to hold the currency at a specific rate against the US dollar. It simply can't happen under our current financial system. While President Trump may reach a deal to shrink the trade balance slightly, there is simply no way to balance it when money is now backed by nothing more than the promises of central banks. Perhaps that's why gold is once again rising, and why inflows into gold have continued to climb all year. If an agreement can't be reached between China and the US, gold prices will likely go even higher. This, of course, means gold stocks should do very well in the near term. Just keep in mind that for as long as interest rates remain low and the Fed continues to intervene, money will likely continue to flow into the stock market, which means gold will still take a backseat despite rising. And while we have many grand successes with gold stocks before, and believe we should maintain a small portion of our portfolio in these assets, we shouldn't be too excited just yet. Gold is up 10% on the year, but the S&P 500 is almost double that. It's once again time to look at gold stocks, but don't jump in all the way just yet. Until next time.